Hi, welcome to my channel, Second PUC Accountancy, Learn, Understand and Excel. Today we are going to see third sum under dissolution of a partnership firm for 12 markers. So let's see the third sum under dissolution of a partnership firm. Ramya, Kavya and Vidya are partners sharing profits and losses in the ratio of 1:2:1. Their balance sheet as on 31st March 2023 was as follows. So this is the balance sheet given to us. So on the liability side, we have creditors 20,000, bills payable 6,000, bank overdraft 4,000, reserve fund 8,000, Vani's loan rupees 5,000, and the capitals of the partners Ramya 42,000, Kavya 35,000, Divya 20,000. And on the asset side, we have cash rupees 15,000, debtors rupees 15,000, stock rupees 18,000, furniture rupees 12,000, machinery rupees 20,000, and buildings rupees 60,000. Now here from the balance sheet, the assets except cash and the external liabilities have to be closed. So the debtors, stock, furniture, machinery and buildings will be the assets that have to be closed, which will go to the debit side of the realization account, and these assets have to be either realized or it has to be taken over, which we will see in the adjustment. Next, on the liability side, we have to take only the external liabilities which have to be closed in the realization account on the credit side. And the external liabilities here are creditors, bills payable, bank overdraft, and Vani's loan. As Vani is not a part of a partner, then Vani will be called as an external liability. So these liabilities have to be recorded on the credit side of the realization account to close the external liabilities, and these liabilities have to be paid off or it should be taken over by the partners. The other entries here are reserve fund and the capital account will go to the partners' capital account to all the partners. And on the asset side, we have cash. Cash will be the opening balance of the cash account at the end. Now, given below the balance sheet is the adjustments. On the above date, they decided to dissolve the firm. The first adjustment says how the assets are being realized. The assets realized are as follows: debtors 13,500, stock 19,800, buildings 62,000, and vehicle which was unrecorded. So it is like an unrecorded asset which was also realized rupees 4,000, and machinery is realized at a book value. When it says book value, it is the same value as given in the balance sheet. So these are the assets that are to be realized, which will appear on the credit side of the realization account under the cash account. Now, under these assets, furniture is not mentioned under the assets realized. So the second adjustment says furniture was taken over by Ramya at a valuation of rupees 9,000. So one asset, furniture, is not realized, but it is taken over by the partner. So it will be transferred to Ramya's capital account on the credit side of the realization account. Now moving on to the other adjustment, it says how the liabilities are being paid off. So creditors were settled at 10% less, and the other liabilities like Divya took over Vani's loan. So creditors are paid off at 10% less, and the Vani's loan is taken over by the partner Divya. So creditors which are paid off will be entered under the cash account. So on in the realization account, it will appear on the debit side as to cash account. And the Vani's loan, which is taken over by Divya, will be transferred to Divya's capital account. Next we have is there is an interest on bank overdraft which is due rupees 400, was also to be paid off. This is like an additional expenses that is paid off by the partner along with other liabilities. So this is a amount of liability that is paid off. So it will also appear on the debit side of realization account under the cash account along with other liabilities. Now, in this, they have not mentioned or given any information about other liabilities like bills payable and bank overdraft. So, if it is not mentioned, we always assume that the other liabilities, external liabilities, are being paid off in full. That is the value given in the balance sheet. So it will be transferred on the debit side of realization account under cash account along with creditors. Now the last adjustment is the realization expenses that is amounted to rupees 4,000. So this is again an additional expenses paid off which will be entered on the debit side of realization account under cash account. So these are the entries which have to be made in the accounts under dissolution. So we have to prepare realization account, partners capital account, and cash account. So now let's see the preparation of the first account, that is the realization account. So in the realization account, first we have to bring down all the assets except cash in its book value on the debit side of the realization account. So first asset we have is the debtors. So two debtors, 15,000. So once the debtors are entered, next we have is the stock. So two stock on the debit side of the realization account, 18,000. So the next asset what we have is the furniture. Furniture should be brought down again on the debit side, two furniture, 12,000. The next asset what we have is the machinery account. So machinery will be two machinery, 20,000, and the other asset is the buildings. So two buildings, 60,000. So we have taken all the assets on the debit side of realization account to close the assets. Now, similarly, we have to take all the external liabilities, that is creditors, bills payable, bank overdraft, and Varney's loan, which is the external liability on the credit side of the realization account to close the liabilities. So first liability we have is the creditors. On the credit side, we have to enter it by creditors 20,000. Next external liability we have is bills payable. By bills payable 6,000. The next liability what we have is the bank overdraft. By bank overdraft 4,000. And the next external liability we have is Vani's loan. So by Vani's loan 5,000. So these are the assets and the liabilities which have to be realized and paid off. Now in the adjustment we have seen that the assets are realized. So the assets realized are given in the adjustment. So assets realized are like assets sold. So we are receiving the cash. So it will appear on the credit side of the realization account as by cash account. That is the assets that are realized. So here when we realize the assets, it appears on the credit side of the realization account, the assets realized as per the amounts given in the adjustments. So debtors are realized at rupees 13,500, stock is realized at 19,800, buildings is realized at 62,000, and machinery is realized at 20,000, and vehicle is realized at 4,000. So the total assets that is realized is 1,19,300, which will be entered in the amount column. Now, out of all the assets, the furniture is not realized, but the furniture is taken over by Ramya at the valuation of rupees 9,000. So we have to bring down the furniture which is taken over by Ramya. Enter it on the credit side of realization account, that is Ramya's capital account. By Ramya's capital account, Since she takes over the furniture at rupees 9,000, so write 9,000 in the outer amount column. Now the assets all are being realized or it has been taken over. Now moving on to the liabilities. Now these external liabilities have to be either paid off or it should be taken over by the partner. As per the adjustments, creditors are settled at 10% lesser and the other adjustments, bills payable and bank overdraft will be paid in full and the external liability Vani's loan is being taken over by Divya. So the amount of liabilities that are paid by the firm will come on the debit side of realization account. So the liabilities that are paid off will be entered on the debit side of the realization account as to cash account as the liabilities are being paid off. So the creditors are paid at 10% discount, so which will be 20,000 minus 10%, which will be 18,000 rupees. Bills payable is paid in full and bank overdraft is also paid in full. So bills payable will be 6,000, bank overdraft will be 4,000, and along with this, there is also an interest on bank overdraft which is to be paid off at rupees 400. So the interest paid off will be 400. That is an additional liability that is paid off. So the total liabilities that is paid is 28,400. Now out of these liabilities, one particular liability that is Vani's loan is taken over by Divya. So which should be transferred to that particular partner's capital account. So which is Divya's capital account, which should be recorded as to Divya's capital account as it is the Vani's loan taken over. It is taken over in full as the amount is not given. So Vani's loan will be taken over in full rupees 5,000. With all these liabilities are now being paid off or it is taken over. Now here there is a dissolution expenses, realization expenses that is rupees 4,000 which should be paid by the firm, which will appear again on the debit side of the realization account as to cash account, that is the realization expenses rupees 4,000. So this will be the realization expenses. Now once all the entries are done, we need to balance it. Now when we take the total of the debit side and the credit side of the realization account, the debit side total will be 1,53,400 and credit side total is 1,63,300. So credit side is more. So write the same total on both the sides, 1,63,300. And so it is, since the credit side is more, it is the realization profit. So we need to bring down the realization profit in this realization account. So it is the realization profit. So it is the profit that is transferred to the partner's capital account. The profit will be rupees 900 that will be transferred to all the three partners. Ramya, which will be 900 into the ratio 1/4, that will be 225. It is distributed to the next partner Kavya, 900 into 2/4, which will be 450 for Kavya. And for the third partner Divya, it is 900 into 1/4, which will be 225. So the total profit that is transferred is rupees 900. So this is the profit that is transferred to the partner's capital account. So this is the realization account. Now let us prepare the partner's capital account, the second account and the dissolution. So first, in the partner's capital account, we have to bring down the opening balance, that is the capital of all the partners given in the old balance sheet. So the balance should be brought down on the credit side as by balance brought down: 42,000 for Ramya, 35,000 for Kavya, and 20,000 for Divya. Now next, in the balance sheet, we have reserve fund. So the reserve fund should be distributed to all the partners in their old profit sharing ratio. So by reserve fund, rupees 8,000 should be distributed in the ratio of 1:2:1, which will be 2,000 for Ramya, 4,000 for Kavya, and 2,000 for Divya. We have to bring down the realization profit, so which we have derived in the realization account. So by realization account profit, that is 225 for Ramya, 450 for Kavya, and rupees 225 for Divya on the credit side. Now next, in the partners capital, we have to show the asset and the liability that is taken over by the partners. So we had transferred in the realization account, which should be also transferred to the partners capital account. Partner Ramya has taken over the asset furniture, so we have to transfer it to the partner's capital account on the debit side as to realization account: furniture taken over by Ramya, rupees 9,000 under Ramya's column. It has to be transferred. Now there's also a liability that is taken over by a partner. So the liability that is taken over will be transferred to that respective partner's capital account. So which will be by realization account: Barney's loan is being taken over by Divya, rupees 5,000. So this is being transferred to the partner's capital account. Now once all these entries are being done, now we have to find the balancing figure. So get the totals. So we have to find out the total of all the partners. So it will be 44,225 for Ramya. So right on the both the sides, 44,225, and for Kavya it is 39,450 on both the sides, 39,450, and for Divya the total will be 27,225. So when we deduct the debit side total, so it will be for Ramya 44,225 minus 9,000, and the debit side totals have to be deducted. So the balancing figure will be transferred to the cash account. That will be the final settlement made to the partners. So to cash account on the debit side, the balancing figure for Ramya it is 35,225, and Kavya 39,450, and Divya 27,225. So this is the balancing figure which we have to transfer to the cash account. So now we are going to prepare the last account, that is the cash account. So first in the cash account, we have to bring down the balance on the debit side from the balance sheet. So it will be written on the debit side as to balance brought down 15,000. Now on the debit side, we have to write down the assets that are to be realized, that have been realized. So the assets realized will be brought down from the realization account. So it will be to realization account. All the assets that have been realized, we will write the total amount 1,19,300 on the debit side. So that is the amount that has been received. Now on the credit side, we have to write down all the payments that have been made at the time of dissolution. So which will be the first entry will be the liabilities that are paid off. So it will be written as by realization account, the liabilities that are paid, the total amount, that is the external liabilities paid, 28,400. Now next entry which we had paid is the dissolution expenses, that is by realization account, that is the dissolution expenses that are paid, rupees 4,000. And finally, the partners' capitals are being paid. So the partners' capital is being settled. So from the partners' capital account, we break down the settlement made to all the partners as by partners' capital account. Ramya's capital balance was 35,225. Kavya's capital was 39,450 and Divya's capital was 27,225. So the total capital that is settled to the partners is 1,01,900. So with all these receipts and payments, we need to find the total, which will be 1,34,300 on both the sides. 1,34,300. So this is the final account that is being prepared at the time of dissolution of a partnership firm. So all the cash receipts and cash payments are matching with each other. So hope it is clear, students. We will see another sum with different adjustments in the next video. Thank you.